2026 is almost here, and the IRS has just dropped its updated income tax brackets and standard deductions. If you've ever felt like you're paying too much in taxes, this news could be a game changer. Every year, the IRS adjusts these numbers to keep up with inflation and prevent what experts call bracket creep. That's when your income increases just enough to push you into a higher tax bracket, even though your actual purchasing power hasn't improved. Here's what that means in practice. A single filer earning $50,000 in 2026 will now be taxed at 12% for the portion of income above the lowest bracket, rather than jumping into the 22% bracket like last year. In other words, you get to keep more of your hard-earned money. But it's not just about income tax rates. The IRS also increased the standard deductions, $32,200 for married couples filing jointly, $24,150 for heads of household, and $1,600 for single filers. And there's more. Seniors could see additional relief thanks to a special provision from the One Big Beautiful Bill Act, giving a temporary deduction of up to $6,000 for Americans aged 65 and older who meet certain income thresholds. That means retirees might pay even less next year, and if you're planning for retirement, knowing this now could save you big. But here's the twist. While most taxpayers will see modest relief, the benefits vary widely depending on income level and location. For some high earners, the tax cut could be thousands of dollars, while lower-income households might see smaller savings. Plus, other changes like updates to the Earned Income Tax Credit, estate tax limits, and flexible spending accounts are quietly reshaping how Americans will handle their taxes in 2026. Over the next few sections, we'll break all of this down: how the new brackets work, how deductions and credits play into your tax bill, and how these changes could affect your bottom line in ways you might not expect. Stick around, because some of the numbers are surprising, and understanding them now could save you serious money next April. One of the biggest tools to lower your tax bill in 2026 is the standard deduction, and this year, it's higher than ever. Married couples filing jointly will see a deduction of $32,200, heads of households $24,150, and single filers $16,100. These numbers mean that a larger portion of your income is shielded from federal taxation, giving you extra breathing room in your budget. For seniors, the benefits are even more substantial. The One Big Beautiful Bill Act introduced a temporary deduction of up to $6,000 for Americans aged 65 or older. But there's a catch. You must have an adjusted gross income of $75,000 or less if filing singly, or $150,000 or less if married. While it might sound complicated, the payoff can be significant, reducing your taxable income and potentially saving thousands in federal taxes next year. Families with children aren't left out either. The Earned Income Tax Credit, EITC, a refundable credit designed to help working households, is increasing for 2026. Families with 3 or more children can now claim up to $8,231, up from $8,046 this year. That might not sound huge, but when combined with standard deductions and other credits, it can make a real difference in your take-home pay. Even other aspects of tax planning are getting an upgrade. The basic exclusion amount for estate taxes rises to $15 million for 2026, offering wealthy families slightly more breathing room in estate planning. And for anyone using health flexible spending accounts, the contribution limit has increased to $3,400, allowing more pre-tax dollars to cover medical costs. But here's the thing most people miss. Understanding these numbers isn't just about compliance, it's about strategy. Knowing how deductions, credits, and exemptions work together can actually change how much you owe, or even how much you keep in your pocket. And that's just scratching the surface. In the next section, we'll break down how these new brackets interact with your income to determine your actual tax rate, because it's not as simple as it looks. Many Americans misunderstand how federal taxes actually work. Just because you fall into a certain tax bracket doesn't mean all your income is taxed at that rate. The U.S. tax system is progressive, meaning different portions of your income are taxed at different rates. This distinction between marginal and effective tax rates can be the difference between paying more than necessary or keeping more money in your pocket. For example, let's take a married couple with a combined gross income of $150,000 in 2026. After applying the standard deduction of $32,200, their taxable income drops to $117,800. That puts their top marginal tax rate at 22%, but only a small portion of their income is taxed at that highest rate. Their first $24,800 is taxed at 10%. The next portion up to $100,800 is taxed at 12%, and only the remaining $17,000 is taxed at 22%. When you add it all together, they end up paying $15,340 in federal taxes, which works out to an effective tax rate of just 13%, much lower than the 22% bracket might suggest at first glance. This example shows why understanding the difference between marginal and effective rates is so crucial. Many taxpayers panic when they see their bracket, but fail to realize the bulk of their income is taxed at lower rates. And here's where it gets even more interesting. With the One Big Beautiful Bill Act in effect, typical taxpayers could see an average tax cut of $3,152 in 2026, but the benefit isn't uniform. Higher income earners may see larger dollar savings, while lower income households experience more modest relief. In fact, families in the top quintile, earning over $217,101, could save over $12,500, while households in the bottom quintile, earning up to $34,600, might see a reduction of only $150. So, knowing your bracket isn't just trivia, it's a powerful tool. By understanding marginal versus effective tax rates and factoring in deductions, credits, and recent legislation, you can strategically plan your finances, potentially maximizing the money you keep each year. But that's not all. The next section reveals how inflation adjustments and bracket creep are quietly shaping who pays more and who pays less, and the results may surprise you. Every year, the IRS adjusts income tax brackets to account for inflation, a process designed to prevent what's known as bracket creep. Bracket creep happens when inflation pushes your income into a higher tax bracket, even if your purchasing power hasn't actually increased. In simple terms, without these adjustments, you could end up paying more taxes simply because prices went up, not because you earned more in real terms. For 2026, the IRS applied an estimated inflation rate of 2.7% to the tax brackets. This means that Americans can earn slightly more before hitting higher tax rates compared with 2025. For instance, a single filer making $50,000 will still be in the 12% bracket instead of being bumped to 22%, which could have happened without the adjustment. This seemingly small change can have a huge impact, especially for middle-class families. Let's say a single taxpayer earns $70,000. Without the inflation adjustment, part of that income might have been taxed at a higher rate, effectively increasing their tax bill. With the adjustment, more of their income is taxed at lower rates, keeping more money in their pocket. Here's where it gets more interesting. While inflation adjustments help the majority of taxpayers, they also subtly shift the distribution of tax burdens. Higher income earners often benefit more in absolute dollar terms because the bracket thresholds are higher. That's why a couple earning $200,000 could see a larger reduction in taxes compared to a lower-income household. But inflation isn't the only factor shaping your 2026 taxes. The One Big Beautiful Bill Act has made key portions of the 2017 tax cuts permanent, meaning some taxpayers could see unexpected savings next year. Combined with the standard deduction increases and credits like the Earned Income Tax Credit, these changes could make filing in 2026 surprisingly favorable for many Americans. Yet some people are still unaware of how to leverage these adjustments. And the real twist? Even with all these protections against bracket creep, timing your income and deductions strategically could mean the difference between paying thousands more or thousands less in federal taxes. Next, we'll break down how standard deductions and credits further affect your bottom line and why seniors and families with children may see some of the biggest benefits. Understanding your standard deduction is key to lowering your taxable income. For 2026, the IRS raised the numbers across the board: $32,200 for married couples filing jointly, $24,150 for heads of households, and $16,100 for single filers. That's more money you can earn before Uncle Sam even starts taking a cut. Seniors could see even more relief. Thanks to the One Big Beautiful Bill Act, taxpayers aged 65 and older may claim an additional $6,000 deduction, but only if their adjusted gross income is under $75,000 for singles or $150,000 for couples. This temporary boost, set to expire in 2028, is designed to ease the financial pressure on retirees, effectively letting them keep more of their hard-earned savings. Families with children also benefit. The Earned Income Tax Credit, EITC, has been increased for households with 3 or more kids, climbing from $8,046 to $8,231. Even a few $100s can make a difference when it comes to back-to-school expenses, groceries, or holiday bills. Meanwhile, flexible spending accounts are getting a small but meaningful bump. Workers can now contribute up to $3,400 to health FSA accounts, up $100 from the previous year. These contributions are pre-tax, lowering your taxable income while covering out-of-pocket medical expenses, a simple but powerful way to save. And there's more. The estate tax limit has risen to $15 million for 2026, up from nearly $14 million in 2025. This means wealthy families can transfer more assets to heirs without incurring federal estate taxes. While this may seem distant for many viewers, it highlights how small adjustments in tax law can have major financial implications. But here's the catch. Many Americans don't fully understand how deductions, credits, and exemptions interact with their marginal and effective tax rates. Missteps in timing deductions or claiming credits incorrectly could mean leaving money on the table or paying more taxes than necessary. In the next section, we'll break down how to calculate your tax rate and understand the difference between what you think you pay and what you actually pay, revealing a detail that often surprises most taxpayers. Many Americans are surprised when they realize they don't actually pay the top tax rate on all their income. The U.S. uses a progressive tax system, which means your income is taxed in brackets. Only the portion of your income that falls within each bracket is taxed at that bracket's rate. Take a single filer making $50,000 in 2026. The first $12,400 is taxed at 10%, then the remaining $37,600 falls into the 12% bracket. Your effective tax rate, the actual percentage of your total income you pay, ends up being much lower than the top bracket would suggest. For married couples, the math can get even more interesting. Consider a couple earning $150,000. After subtracting the 2026 standard deduction of $32,200, their taxable income is $117,800. This puts them partially in the 22% bracket, but their effective tax rate is only around 13%, much less than the 22% you might expect at first glance. Here's a quick breakdown. First $24,800 taxed at 10%, $2,180. Next, $76,000 taxed at 12%, $9,020. Remaining $17,000 taxed at 22%, $3,740 total federal tax, $15,340. Effective rate, 13%. The key takeaway: knowing the difference between marginal and effective tax rates can help you plan smarter, from deciding how much to contribute to retirement accounts to timing deductions or managing side income. But it gets even trickier. With the One Big Beautiful Bill Act, average taxpayers could see an additional $3,752 tax cut in 2026, but the impact varies widely depending on income level, location, and filing status. Lower-income households may see a modest reduction, while higher earners could enjoy more significant savings. Here's a question to think about. If your neighbor earns more but pays a smaller effective tax rate than you, Why is that possible? The answer lies in deductions, credits, and smart tax planning, details most Americans overlook, yet they could unlock thousands in savings if understood correctly. Next, we'll explore how the new legislation specifically affects different income groups and reveal some lesser-known strategies to maximize your 2026 tax relief. Now that we've broken down brackets, deductions, and effective tax rates, the next question is, how can you make the system work for you in 2026? First, take advantage of the standard deduction. For married couples filing jointly, that's $32,200. For single filers, it's $16,100. If you're 65 or older, the One Big Beautiful Bill Act offers an extra deduction of up to $6,000, but only if your income is below certain thresholds. That's free money you don't want to leave on the table. Next, consider credits like the Earned Income Tax Credit. Families with 3 or more children can claim up to $8,000 in 2031, slightly higher than last year. Every little bit counts when it comes to reducing your tax burden. Even contributions to health flexible spending accounts matter. In 2026, you can deposit up to $3,400 pre-tax, effectively lowering taxable income while covering medical expenses. But here's the surprising part. Location and income strategy can dramatically change your results. A taxpayer in the top quintile could save over $12,000, while a lower-income household sees smaller gains. Understanding your unique situation and planning ahead is key. Finally, don't forget that progressive taxation means strategy matters. Even a small adjustment in retirement contributions, health savings accounts, or charitable giving can shift your effective rate and unlock thousands in savings. So, as you prepare for 2026, ask yourself, are you maximizing every deduction and credit available or leaving potential savings on the table? The choices you make now could mean the difference between a stress-filled tax season and keeping a surprising chunk of your hard-earned money. And just when you think you've covered everything, there's one lesser-known tip that could save even more, but very few people know about it. And it's something we'll explore in future updates.